Now the topic before us is the logic of reserves, exploring their significance in fractional reserve banking. It the question means that if say we deposit say rupees say $1,000 in the bank, the banks have to keep some portion of the deposits as reserves, say 10%. 10% is reserve requirement. Now the banks are in a position to lend $900. Now the question is why the commercial banks keep 10% or whatever ratio is fixed by the central bank. Why these reserves are kept by the commercial banks? Why the banks do not give all this deposit, all the deposits which are available with them as loan? Why do not they give all? So now we will again read the question. Why do commercial banks need to hold reserves in fractional reserve banking, or what is the purpose of reserve requirements in fractional reserve banking system? As you know that whenever a deposit is created or deposit comes in the bank, the banks keep a certain percentage of the same as reserves, and they may use the balance amount to give loans to the customers or to make investments. Now the question is, who fixes the reserve requirement? This reserve ratio or the reserve requirement is fixed by the central bank, which in case of USA is Federal Reserve, and in the case of India it is Reserve Bank of India. So now we will find out the answer for keeping reserves. First is to meet withdrawal demands. Now when a large number of customers, say one has deposited $1,000, another may have deposited $100, another may have deposited $50, some may have deposited $2,000. So when there are thousands of customers in each bank, they might require this said money at some point in time. If I have deposited say $1,000 in the bank, after 2 months or 3 months, it is quite possible that I will need the same, or the other customer may require the same, say after 10 days, say after 6 months. No, the banks cannot guess when the customer will come. So, to meet the withdrawal demands of the customers, the banks have to keep reserves with them so that they are in a position to meet the withdrawal demands of the customers. It is not that the customer comes and the banks have given all the deposit as loans and they are not having anything in cash available with them. So these reserves are set aside to ensure that the bank can meet withdrawal demands from its depositors and maintain a certain level of liquidity and stability. Next is to prevent bank from making too many loans. The reserve requirement prevents banks from generating too much money by making too many loans against a narrow deposit base. As already told that when initial deposit of say $1,000 is made and the reserve ratio is say 10%, it may change from country to country. Then the banks are in a position to give $900 as loan. If say this reserve requirement is not there, then the banks will be in a position to give all this amount initial deposit as loan, and again this amount will get deposited and again they will give it on loan. So they will be in a position to give too much loans against this initial base, because this amount will again get redeposited, and again they will give loan of $1,000 if there is no reserve requirement, and this process will go on, continuously go on, and on a very narrow deposit base of say $1,000, they will be in a position to give large number of loans. So next point is tool for controlling money supply. Reserve requirements are a tool for controlling money supply. The central banks have the authority to increase or decrease reserve requirement. This reserve ratio is fixed by the central bank in each and every country. They have the authority to fix it on the basis of the market conditions, whether they want money supply to increase or money supply to decrease. They increase or decrease the reserve ratio. If they increase the reserve ratio, say it becomes 10 to 20%, they increase, what will be the position? Then on the basis of 1000 deposits, the banks will be in a position to lend only $800, because reserve ratio is 20%. So market supply, money supply will decrease if the reserve ratio is increased. If the reserve ratio is decreased, say it is decreased to 5%, so the banks will be in a position to lend $95, $950. So the money supply will increase. So if on the basis of the increase or decrease of money supply, it will impact the interest rates, inflation, and overall economic activity. We will discuss all these points in the coming videos. Next is help by central bank in exceptional situations. We have already told you that when a deposit comes to a bank, the central bank, the commercial bank has to keep a fraction of those deposits as reserves. These reserves are in the shape of cash. When a deposit comes, some percentage is kept as reserve ratio. These reserve ratio may be in the form of cash kept in the bank, and some amount is kept in the central bank account. Some amount is kept in cash and some amount is kept in the accounts of the central bank. So it may be situation that sometimes there are a large number of customers which come to a bank and start withdrawing their money. It may be on the basis of some rumor that the bank is likely to fall or likely to become bankrupt. There may be rumor in the market, so the large number of customers will come to the bank to withdraw money. So in that cases, the central bank will use this amount which is deposited by the commercial banks with the central bank. They will use this amount to give money to the commercial banks so that they can meet the withdrawal demands of the customers. So this amount will be given to the commercial banks in the case of extraordinary situations, when large number of depositors come to the bank to withdraw money, or in the case of bank run. Bank run means when the large number of customers come to withdraw their money. Reserve requirements can vary from one country to another. It may be quite possible that in one country the reserve ratio is 10%, in another country it may be possible that it is only 5%, in some countries it may be 4%. It depends on the central bank of the country to fix the reserve ratio, and they can also change over time. It is not that once fixed they will not change it. the central bank keeps on changing or will keep it fixed. It is the prerogative of the central bank to keep it as it is or to change, increase or decrease as per the economic conditions of the country within a country based on the monetary policy objectives of the central bank. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.